What's up, my people, and welcome back to the channel. My name is Diamond, and phase 2 is in full effect, and that's investing. So if you're serious about investing, you're in the right place. And it doesn't matter if you want to invest in the stock market, the bond market, or even crypto. There is something that we all have to have an understanding of, and that's fees. More specifically, expense ratios, and that's what I'm going to cover in great detail in this video. And if you want to start investing but you just don't have the capital available, I want you to check out this playlist here on how to get out of debt. This is information that me and my wife used to pay off over $100,000 worth of debt. And now that money that we were sending to the creditors each and every month is being invested to help us build wealth for our family. So tell me something. What does index funds, actively managed mutual funds, bond funds, and REITs have in common? They all have a cost associated with operating the fund, and that's your expense ratio. The expense ratio covers everything that is needed to operate the fund. So you're paying the management fee, you're paying transaction fees, you're paying for everything down to the paper and ink that the statements are printed on. So what these companies do is they add up all of the expenses associated with the fund. Then they divide that number by the assets under management. And then the number that's derived from that calculation is what the expense ratio is going to be. And this is charged to every single investor in that fund. But I'm a visual learner, so enough talking. Let me show you this in action. Here we have a list of growth stock mutual funds. They're all in the same category, which means they are peers of one another. So you can compare what they're invested in. You also can compare their rates of return in addition to their expense ratios. And that's where I want to draw your attention to. Here we have the net expense ratio, and it's expressed as a percent. Here we have 0.79% or 1.03%. Another way to say this is 79 basis points, or the difference between these two funds is 3 basis points. But what does that mean? What kind of impact is that going to have on your investments? Well, for me, when I see expense, I think cost, and this is going to cost me some money. So the only way for me to really understand the impact of an expense ratio to my investments is I have to look at the actual dollars. Now, real quick, comment down below and let me know what's your cutoff. What's considered a good expense ratio for you? Because when we sort highest to lowest, you can see some of these funds have expense ratios north of 2%. What is your cutoff? And to put numbers to these expense ratios, let's jump over on Vanguard's site and look at a scenario they laid out where you have two people who invest $100,000 and they invest this amount for 25 years, earning 6% a year. Now, one person pays no cost, absolutely zero fees. The other person pays 2% a year in fees. Now, person A generates $330,000 in earnings off of their $100,000 investment. Now, that's compound interest at work for you. Person B, on the other hand, generated $160,000 in earnings. So what's up with this $170,000? Well, that $170,000 is what 2% a year costs this person over the 25 years that they were invested. So one person has an account balance or account value of $260,000. Meanwhile, person A has an account value of $430,000. Now, here's the sneak attack. You don't receive a bill that shows you exactly what your fee is costing you each and every year. On the contrary, you receive a statement which shows your expense ratios shown as a percent, and it shows you how much your account has grown. So if this person don't understand the impact of fees going into their investment, there will be no way for them to know that they missed out on $170,000. And when you compare these two, that's a 40% difference between person A and person B. And that's why understanding expense ratios and their impact is important before you invest money. And that gives a whole new meaning to these numbers that we see here. So where can you find the expense ratio? Now, here we're using Fidelity's free mutual fund research tool, and you see all the expense ratios laid out here. Another way you could do it is no matter what fund you're looking to invest in, you can pull up the fund online and you'll be able to see the expense ratio there. You also can look up their prospectus And in the prospectus, you're going to find the expense ratio for you there as well. And if you want more detailed information, you can pull up the annual report, find their financial statements, and go to the statement of operations. And here you'll see the expenses laid out for you line by line. And if you really want to nerd out, you can look at the notes to the financial statement, and that will tell you exactly what each of these line items mean in great detail. And it don't matter if you're looking at Fidelity funds or somebody else's. Here we have Charles Schwab. We have a bond index fund, and you can see the expense ratio here is 0.04% or 4 basis points. You can pull up the prospectus here. We have Vanguard VSAX, which is one of their most popular index funds, and you can see the expense ratio is 4 basis points. And if bond index funds or equity index funds is not your thing and you want to invest in ETFs, well, you can get the ETF equivalent of that mutual fund, and the expense ratio is 0.03 or 3 basis points. Now, here's another real world example of the impact of fees. So here it shows the expense ratio for this fund, and it compares it to the average of similar funds, and that's 83 basis points. If these numbers was converted to actual dollar amounts, you'll see that if you invested $10,000 over 10 years, and you had an expense ratio of 83 basis points, that would cost you $1,893. Meanwhile, this fund will cost you just $71. That's a savings of $1,822, which once again breathes a whole new life and whole new meaning to these expense ratios that you see here. If we learning together, let me and YouTube know by giving this video a thumbs up and clicking the like button. Another thing to note about expense ratios is when you see the returns here, and it shows that this fund returned 75% over the last year, the expense ratio has already been deducted from the returns that you see here. So this number is net of the expense ratio, which may have you thinking, well, if this number is net of the expense ratios, well, then I'm just going to sort by the returns over the last year, and I'm going for the one with the highest returns. And who cares if it has a 1.1% expense ratio? This is where the default disclaimer in the investment world comes from. Past returns does not guarantee future results. So just because it returned 93% last year, don't mean that it's going to return 93% this year. Also, a high expense ratio does not correlate to high returns. So just because you're paying a lot of money to be in a fund, that's not going to guarantee you high returns either. And even if you come over here and you sort by 10 year and you say, well, I'm going with 10 years. That's a long track record. Well, 22% is pretty good, the highest on this particular list. And look, it's the same fund. So this is looking like a good fund to invest in. Well, here's where I would caution you. Expense ratios is just one type of fee. You can also be charged as you put money into an investment. You could be charged on the back end when you take money out of the investment. And I'll give you a hint. When you see Class A, just know that there are additional fees associated with getting into this particular investment. And that don't make it a bad thing in and of itself. But if you don't know this stuff before you get into an investment, then that definitely makes it a bad thing because you're investing money in something that you don't truly understand, which is going to skew your results. In fact, if you pick any singular thing to pick your investments based off of, you have a high probability of not achieving your investment goals. And that's because in order to be a successful investor, you have to take a holistic approach when developing your investment strategy and when picking your investments. If you're new to investing and you want more information, I want you to check out this video right here, which is my beginner's guide to investing. I give you 5 things that you need to do before you start investing and 5 things you need to do as you're choosing your investment and putting together your investment strategy. And if you want more information on investing, make sure you're subscribed to this channel and your notifications are turned on. Thanks for rocking with me, and until next time, I'm Diamond. Peace.